Good morning, students. So today is our second day of the lecture on infrastructure finance paper. And let's start, I think. We, we are going to discuss today this project finance and PPP markets. That will be our first topic. And second topic will be related to the, this one is structuring the project, how we structure a project. That we will discuss. These two topics we will try to finish today. Uh, I'll share now the slide with you here for the first. Yeah, let's share the slide first. Yes, here it is. Project finance and public-private partnerships. So this is the topic, first one, which we will discuss. These are the subtopics of this chapter: agenda and learning objectives of this PPP partnership. First, we will talk about the introduction to project finance, definitions and core concepts, then global project finance markets, current status and trends. Then third topic will be sources of funding for large projects. Then key institutions in India like IDFC, IIFCL and other schemes. And last one in this chapter is capital markets and innovations for project finance. So let's start with the first, the key institutions in India, this one, and then the challenges and the role of multilaterals in this project finance. So first, the definition. What is project finance? The project finance or financing long-term infrastructure and industrial projects based on the projected cash flows of the project rather than the balance sheets of its sponsors. So basically, it is not the uh, balance sheet of sponsors based, but on the basis of the cash flows of the project. Key characteristics of this project finance is special purpose vehicle SPV. Project is a distinct legal identity. Then high leverage, significant use of this debt financing. And third one is non-recourse or limited recourse. So lenders' claims are primarily on the project assets and cash flows. Whatever lenders have are there in the projects, they are based on the assets and cash flows. So this is the these are the three main characteristics of this project finance. As far as the conceptual framework of this is concerned, we have seen that infrastructure deficit has become the most glaring deficit that government around the world have to deal with, and more so in South Asia, particularly India. So in order to sustain the gross domestic product, India has planned an investment of almost 41,000 billion in infrastructure in the next 5-year plan. So this is the figure for in the beginning of this 21st century, that is the period from 2004 to 2009. So that governments are no longer able to finance now infrastructural projects solely or even predominantly from the public purse or public funds. So given the huge infrastructure investment needs, governments, limited resources and managerial constraints in the public sector, and buoyancy in the capital market, the roles of the private sector and PPP in enhancing infrastructural facilities have been become very critical. So this is important. So because of the shortage of funds with the government, this model has become very obvious to adopt. This term PPP is a global concept, but without a single internationally accepted definition. Traditionally, it defines the transfer of investment projects which have been executed or financially financed by the public sector to the private sector. So basically, PPP refers to a contractual arrangement between a government agency and a private sector. So basically, it's a uh, arrangement between private and government, which allows for greater private sector participation in the delivery of public infrastructure through concessional agreements, which lay down the performance obligation to be discharged by the concessionaire. So this is the standard definition. The principle behind a PPP is the development and operations of public utilities and infrastructure by this private sector under terms and conditions agreeable to both the government as well as the private sector, right? So PPP offers significant advantages in terms of attracting private capital to create public infrastructure and enhance efficiency in the provision of services to users. So they bring in new sources of capital for public infrastructure projects. And such projects progress on schedule and sometimes on budget as well. So PPP projects lead to cost saving in terms of, so it makes a very um, effective savings in terms of lower construction cost, reduced life cycle costs, and lower risks. The projects results in better customer services. This is because of the fact uh, that we know basically that on the basis of the completion of the project to a set of performance standards. So these are the actually three basic reasons to be agree to join this kind of allocation, that is PPP allocation. First one is resource allocation efficiencies, right? That is next one. It's here. So PPP models commonly are build, operate, and transfer one, that is called in short BOAT. BOAT models which are user free or annuity based. So both can be there. Either user fee is there applied later on, or you have some kind of fixed amount for free providing of these services, that is called, and then after that you start charging prices for that, that is BOT. Second model of PPP is built on operate and then transfer. So basically uh, this is this comes the additional part of that for the time being, that owner or private partner can operate it for a certain fixed period and then transfer it to the government after the expiry of their its contractual period. So this on the difference between BOT and boot, that is BOOT, boot, is except the asset ownership is with the operator and sold to the government for either a nominal market value with a cap of the amount. The third one is design, build, finance, operate, and transfer. In short, it is called DBFOT. So that one is the model. Next one, the design, finance, then operate and transfer. This is based that may be for extension of a kind of build, operate, transfer model. Then operations and maintenance contract. Operation maintenance transfer means or contract means operating during the concession period and transfer back to the government agencies later on. So this is the next model here. So PPP ecosystem, if we talk it in terms of India, in India's context, then India is, as we can see, Strux shares the risk among all stakeholders and reduce the risk to long-term providers of this finance. And the risk to the financiers will be reduced only when enforceable ground rules are laid down by the institutional governing PPP projects. So let's talk about the this suitability of project finance and synergy projects finance and PPP. Actually, typically private sector consortium forms a special, commonly called the special purpose vehicle to uh, build and maintain the assets. So this is basically about the consortium. Consortium is usually set up with a contractor, a maintenance company, and a lender, right? It is the SPV basically that signs the contract with the government and some contractors to build the facility and then maintain it. So basically, we are talking about the suitability of project finance bank loans for PPP projects. And this structure allows lenders to take control of cash flows through trust and retention and escrow accounts. What do you mean by these trust and retention account? Trust TRA? TRA is opened by the lead bank, which is also called the facility agent, to keep a track of payment made for the purpose of the project. So basically, this is the facility agent, a kind of facility agent. This is normally done through a waterfall mechanism, and in a project, it is triggered in case of contingency, right? So basically, this is the main aspect of this. The next one is global project finance market. What is the present status? Currently, there is a steady growth in these kind of financial market projects funding. A key driver for infrastructural development worldwide, especially in energy, transport, and social infrastructure. This we had discussed earlier also in the previous lecture. So that one is a very important aspect, that there is a very fast growth in this kind of financial market. Then what are the regional trends? In Asia Pacific region, this dominates and it deals with in volume led by India, China. India is one of the major player in this kind of project finance. Then Europe is also the area where mature market prevails with a focus on renewable energy and digital infrastructure. As far as the American continent is concerned, there is strong activity in energy and transportation projects in this area. What are the main reasons or key drivers behind this expansion or growth of project finance? Huge amount. First one is urbanization. As we know that in urbanization, we need the biggest amount of infrastructural facilities for making this process of urbanization fast, building cities, modern cities or smart cities. You need huge amount of investment in various kinds of infrastructural activities. Then to recover or to gain climate change is, goals, climate change is giving them the opportunity to adopt the modern technology to build various kinds of infrastructural facilities. So due to this climate change, new kind of technologies are being adopted in the various activities in expanding the infrastructure. And then post-pandemic period, that is also recent one. After pandemic, you have a need the recovery spending, means you, if you want to recover, then you need funds, while government has the shortage of funds in this post-COVID period. So this is the also another reason why this kind of financial market is emerging rapidly. So these are the aspects. So domestic, of course, what are those agencies which are sources or sourcing these funds for large projects? As we discussed last time, domestic sources may be either in debt form, it is domestic. Uh, First form is debt, and then the second one is equity. In debt, we have domestic commercial banks, domestic term lending institutions, domestic bond markets. As far as external sources are concerned for debt, they are like international commercial banks, export credit agencies, and multilateral agencies. So these are the debt forms. As far as equity forms of this finance is concerned, sources of funds comes from domestic developers, and then public, of course, government or public utilities. External sources for equity finance is project leasing or multilateral agencies like you have Asian Development Bank, then IMF. There are other international financial market. So these are the sources in terms of equity. So they are the main sources. Uh, as far as we can understand, non-bank financial companies or finance companies are having very crucial role in infrastructure finance. At present, there are three categories of NBFC, that is non-banking financial companies. First one is asset finance companies, second one is loan finance companies, and third is investment companies. All these have to maintain a minimum capital adequacy ratio of 12% in India. That is the condition to maintain. And RBI has given permission to set up infrastructural finance companies in India. And all criteria of NBFC apply to IFC also. So these are the details. What are the conditions? And NBFC can also offer off-balance sheet solutions such as equipment leasing, and can be in the business of purchasing securities such as share bonds and debentures. And they can have higher risk appetite due to better credit appraisal, and can focus on a specific niche business segment. So these are the main features of. As far as there is another source in India, that is real estate investment trust and infrastructure investment trusts. To increase the depth of this property market in India and to increase the availability of finance for construction industry and particularly to real estate, there is a regulatory framework that ensure transparency and high governance standards and promotes regular monitoring of their performance. That's why Indian government has decided to make these real estate investment trust and infrastructure investment trust. And but they are expected to do the following. Number one, liquidity that can raise units from residents. So the units will be listed and the assets will be held by the trust or the SPV, right? So these are the main The first one, liquidity, it is related to monetizing the real assets. Second is the diversification of investment in real estate, how to diversify the funds in this real estate. And third one, providing stability in the real estate market. So these were the three expected objective of giving this, making this real estate investment trust. So this one, I'm giving you the idea of this kind of uh, investment infrastructural regulatory agencies we have. So this I have covered already. You also have a model here which is very uh, specific to India, related to national highway construction. And for that, government had developed this securitization model uh, by the this National Highway Authority of India, and that is called NHAI, to address the market risk of this toll collections. So to allow a flexibility in refinancing loans for NI or NHAI, securitization or additional lending of up to 30%. How much? 30% of the cost of original project was allowed. What was the idea? The idea was to infuse more liquidity into the sector. So that is why National Highway Authority of India, that is NHAI, in the interest of the public, decided to expropriate the project, or else the bankers would have suffered and would have hesitated to find projects in the future. So that was the purpose to securitization of these funds. This model was developed for NHAI. So this is specific to India. There are also uh, multilateral agencies, basically, which basically finance this infrastructure in Asian countries. Let's talk about that. So as we discussed earlier, that banks are constrained by the long-term nature of funding, which is required by infrastructure. So ideally, pension and insurance funds play a main role or key role through bond markets in developed countries. But as far as developing countries are concerned, as the bond markets are not so developed, so very limited actually long-term funding is available in these Asian markets. Therefore, multilateral development banks like World Bank, the Asian Development Bank, have been important funders and supporters of government for infrastructure in developing countries. They are playing very crucial role in Asian countries. Okay, so this is the very important part. I think we have. So this is the one part, that multilateral agencies like regional development banks, such as Asian development banks. Then we have um, IBRD, International Bonds, sorry, African Development Bank in Africa, AFDB. They are playing a very crucial role in financing these projects. So let's talk about the key. I have discussed this uh, in infrastructure leasing and financial services limited, that we have discussed earlier. So as I said earlier, that this another India Infrastructure Finance Company Limited is also an important agency in India's case for financing this infrastructure. And it is a government-owned NBFC which was set up in 2006 to provide long-term financing for viable infrastructural projects. Its key functions are providing direct lending to projects, then refinance to banks for infrastructural loans, and third one is credit enhancement to help projects raise funds. As far as its objective is concerned, the objective was to fill the gap between long-term infrastructural needs and short-term resources of commercial banks. So this was a very important agency to fill this gap. As far as what kind of contribution it has made, so basically they have covered or solves the problem of asset liability mismatch for commercial banks because they give long-term loans with the short-term deposits. So that gap can be bridged through this kind of through this kind of lending. How it works? A commercial bank initially funds the project. Once the project is operated and stabilized, then IIFCL takes out the loan from the bank's books. So basically, they transfer the loans to their own books, and the bank's capital is freed up for new lending. So initially, it means the funds are given by the original bank, and then it is shifted to the this financial agency. What is the benefit? The benefit is it encourages bank participation in project finance, and then it provides long-term stability to project funding. So it guarantees the stability of the financial health of that particular project in long run. So this one is the objective of this particular one agency or institution in India's case. So I hope this particular chapter which we have discussed today, I mean related to PPP uh, model and main question which comes from this topic, if you people want to note down, then I can tell you the main few questions which you can attempt. You can note down this. The first one is related to what is PPP means, or what do you understand by public private public partnership in and PPP markets. Then what are the types of PPP and what are the main source of funding for this kind of models in India's case or in India's market. You can give the examples of few developers in this. So this is the probable areas which we discussed in these topics. We are doing the second unit in this. So we have, this is one of the main topic in the this paper which you can try. So now let's go for to the second chapter, next chapter, that is structuring the project. In this, what are the how the project finance differs from traditional corporate finance in terms of structure, then contractual bundle and complex documentation, right? So before actually we calculate the value of a project based on future cash flows, it is important to know whether project documentation is capable of mitigating the risks that arise to the top line of the project. And why are we doing it now and not later on? It is because we believe that if the cash flows do not come, then project valuation serves no real purpose. So in this chapter, we talk about the structure of a project finance deal. So let's first share this here. Give me a minute. So let's go to this next chapter, that is structuring the project. So these are the subtopics: key project parties, then contractual roles, and essential project documents, financing documents, security. So basically, the challenge before the lenders of infrastructure and non-infrastructure projects lies in evaluating the viability and bankability of a project. And by the proposal appraisal process, which are mainly, we will discuss this. The key to successful project appraisal is in ensuring that the project has passed through a stringent appraisal process. Means you must have a very soundproof kind of appraisal process and risk evaluation. And this process requires that a lender understand the importance of a structure, tight structure, and documentation. So this documentation act is very, say, actually a kind of second line of defense when cash flows do not build up. So let's talk about this. Uh, as a project moves from conceptual and developmental stage to financing and therefore to implementation stage and finally to operations, several project parties get involved with the project. It's not, it's a multifaceted kind of work. And it is therefore important for the credit officers to identify these parties and the contractual framework of, we can say, just a minute. Yes. Okay. So as far as these project sponsors are concerned, first let's talk about the project sponsors. We have, give me a second. So this is the introduction to project structure, the project's ecosystem. A project finance deals through a complex web of interrelated relationships The structure allocates risks and rewards among the various parties that we have already discussed. And we should have a well-defined structure, which is very crucial for attracting financing and ensuring projects success. So basically, the core principle is that the risk must be allocated to the parties which are best able to handle it or to manage it, right? So as far as key project parties are concerned or sponsors are concerned, so we have equity investors, we call them project financer sponsors, who provides capital and then bear ultimate risk and expect returns. So let's talk about the first one, that is equity investors or sponsors. Equity sponsors or the project sponsors means promoters or developers who normally um, belongs to established business groups in these financing markets, and they are responsible for converting a concept into a project. So they realize the project basically and conceptualize it. So they have a role in setting up a project vehicle, which we call SPV, and then identifying and recruiting the right managerial talent to implement and run the project, providing a clear mandate to such a management on their own objectives or on their own expectations. And they also finally subscribe to a position of equity, to a portion of equity in the project vehicle. So the implementation of a project involve mobilization. Number one, mobilization of various resources by the sponsors. Second, finance and management. And then also engineering, pre uh, procurement and construction contractors, legal experts, sector dominance experts, etc. Hence, the mobilization strength of the sponsors that is very critical, as the management team put up by them should have relevant experience in the project area. So this is very crucial, how they select or how they appoint these their management team, right? So as far as project vehicle are concerned, infrastructural, second one, this is project vehicle. What do you mean by project vehicle? The infrastructural projects mostly involve these project vehicles. They are responsible for evolving and delivering a bankable project, then implementing the project, and thereafter operating it in a financially viable manner. It selects and appoints, this project vehicle selects and appoints all the project contractors, right? And then they negotiates and execute the contracts. So they also raise the finance, supervise the construction and commissioning, and operate the project either directly or through an openness and maintenance, that is O&M contractor. Non-infrastructural projects may involve SPV or could be an extension of the existing capacity or integration. So that is for non-infrastructural projects. Now, second one is lenders, or we also call them debt providers. They may be banks or financial institutions who are providing the major portion of the fundings. They provide debt, as I mentioned. The lenders could be either banks and institutions or investors in securities such as foreign currency, convertible bonds, preference shares, and bonds. Okay. So this one is, these are the basically consortium of project lenders, which is led by a lead bank that appraise the viability and bankability of a project based on the project cost and the corresponding means of finance. The lead bank deals with the project company, disburse debt, and is responsible for monitoring during the construction phase. and on commissioning it, monitors the performance and operations of the project until all debts are repaid. So basically, bankers have a claim on project assets and do not normally interfere in the day-to-day operations of the SPV. However, under condition of default, the major these project lenders enforce their rights and they are triggered under the covenants of events of default, right? So this is about the project lenders. Then there are other kind of parties, other key parties. Then that may be a network of various entities which who are crucial for development, construction, and contractual operations. Few of them are such as uh, EPC contractor. What is EPC contractor? The EPC contractor design the project, procure all the engineering skills and equipment to construct the project, erected all the project facilities, ensure that test and trial runs are completed, and finally commission the project on a in a very fixed time and fixed price basis. Basically, EPC contractors' key objective is to deliver a project as per the predefined specifications within a limited or certain cost and time frame. Then EPC also provides performance guarantee to the SPV, right? It may choose to subcontract certain portion of the assignment to other contractors, but such subcontractors does not relieve it from its sole responsibility of delivering a constructed projects to the SPV. So these are the main, we can say, the features of APC contractor. Then government is also the very important part of this contractual party, which we are talking about. The government is a key project party, especially in the case of infrastructural projects, which are implemented under public-private partnership. And this provides a concession to the SPV to set up the project and ensure that a proper legislative and regulatory framework exists, which allows the concerned SPV to compete in a level playing field environment. So in some cases, such as the electricity generation sector, the state government counter guarantees the performance of SEBs like state electricity boards, and in certain cases, such as the government counter guarantee the performance of the state government. So basically, this is the major role of the government as a key contractor in these PPP model. So next one is related to the suppliers. So we are talking here this EPC, since we have signals all major contractors, the borrower for, uh, so we have discussed about the EPC, then government. Now suppliers. The suppliers are critical in the project development stage. Normally the EPC contractors tie up with the suppliers of material before the construction phase. So basically, when construction takes place, by that time, the EPC contractors tie up with the suppliers for raw material. In particularly, if we talk about the power projects, suppliers of raw material for power production are critical. Equipment suppliers are critical in power projects, and sometimes there is a huge delay in the supply of supercritical equipments, particularly for power plants. So as power plants get delayed, equipment suppliers are sitting on overcapacity and a meltdown in their order books. So, for example, supply of coal or thermal power plants has to be tied with the Coal Corporation of India. And then if the power plant is not located in the vicinity, then transportation of coal also needs to be arranged. So there are examples of many power plants that have in India faced delay in starting production. The reason is because supplies of inputs were not tied to on time, and as many as six gas-based project power plants, uh, including those operated by Lenco and then GVK, with a combined capacity of more than 2000 megawatt in Andhra Pradesh, had stopped operation in 2013 due to shortage of gas. So this is a very crucial aspect in this part. So these are the examples I have given. Already we have discussed. So critical for lenders. This one is, as we said, government and regulatory bodies. We have discussed this. Suppliers and off, as we are discussing now, off-takers, they commit to purchase the project's output, basically whatever is produced like electricity or water oil. Who are the agencies? Those who are buyer of their product or supplies. Then they provide basically the primary revenue stream to this kind of infrastructural project. So there may be some company in that like power purchasement agreement who can develop these agreement with the buyers of the product. So let's talk about now the key project documents in the case of a power, oh sorry, in infrastructural finance projects. So the major project documents play a very critical role in establishing the contractual bundle for the project vehicle. These documents also work as comfort for the lenders. So what are those key documents? The first one is concessional or concession license agreement infrastructure in the infrastructural project. So what is this license agreement or concession agreement? Basically, in the case of infrastructure projects such as road, port, and airport, this is the first agreement that the project SPV signs through the bidding or a tender system, right? So this was in the beginning of start doing the agreement. This is an agreement with the government granting the right to the project vehicle to develop the project. This is called concession agreement in road projects, licensing agreement in telecom projects. Licensing project, telecom, this is licensing because where license to participate circles are bid by the telecom service providers who operates, maintains, and develop agreements in case of airport privatization, and a memorandum of understanding MOU in case of power projects, right? The concession agreements deliver the project site to the private developer. Normally in the concession agreements, the government public body agrees to meet the rehabilitation and resettlement expenses if there is any. Then the concession agreement specifies also the term of the agreement, such as 12 years in the case of 6-lane projects in the road sector, and also the termination rights in case of end of concession period or force major closure in the uh, event of political disturbance. So basically, this is a common clause in contracts that essentially free both parties from liability or obligation when the extraordinary event happens beyond the control of the party. So it lays down the technical specification and terms and condition for any direct agreement. Okay. And they are called the state support agreement. What we call it? State support agreement. So this one, these are the core documents we are talking about. Next one is shareholder agreement. Shareholder agreement is the agreement between all the shareholders of the SPV, including project sponsors, promoters, which establish the shareholding pattern. The shareholders' representation in management in terms of conversion of PE investors, private equity investors, debt into equity, exit route for PE investors, and minority protection rights. Okay. So this one is about the uh, this one, what we call it, the shareholders agreement. Okay. So basically, the shareholder agreement is very critical as it ensures that equity funding is fully tied up and available to the SPV as per their financing requirements. Okay, and it also attempts to ensure a smooth functioning of the SPV and certain decisions lays down in a simple process, basically. So this helps to bankers also in clearly resolving disputes between shareholders on one side, and then uh, basically it also prevents the project from suffering losses because of shareholders' apathy or disinterest, as it defines the rights and responsibilities very clearly or explicitly. So this one is the shareholder contracts. As far as EPC contracts are concerned, this one is the next one, EPC contract. The agreement between the SPV and the EPC contractor establishes the EPC contractor's sole responsibility, which is for what purpose? In designing, procuring, constructing, testing, and finally commissioning the plant facility accordingly, right? So it lays down guarantees and minimum performance parameters that the EPC contractor will need to achieve. Basically, it also fixes the responsibility of the contractor to rectify the plant if it fails to meet the guaranteed performed parameters. And basically, or typically liquidated damaged are are capped at 20% of the EPC contract value. A well laid out EPC contract protects the project against time and cost escalation also, particularly if it is a fixed time, fixed price contract. However, in the road sector, if we talk about the road sector, it is often a project such as construction contractors who see the SPV and EPC contracts back to one of the sponsors. As many sponsors, SPVs in road projects are construction contract themselves. Okay. But this happens only when the sponsors has an extremely strong track record in the sector. And in addition, by seeking warranties from the contractor, the SPV ensures that for an adequate defects liability period, spare para are available and repairs are carried out by experienced personnel at zero level or at the low cost. So this is very crucial part of it. So we are talking about the various contracts which exist in this kind of model. So let's talk about this. So this we have discussed. These are the key provisions for lenders. And we can also talk about the next one is uh, offtake agreements. Offtake agreements are basically we have what are the common types? The common types are one is take or pay. Offtake pays even if it doesn't take the product. Then power purchase agreement. So these are the two kinds of O&M contracts or offtake contracts. So let's talk about specifically the power purchase agreements as a in the case of power projects. So this is actually the most important document, this agreement, which is directly related to the sale of electricity and cash flows generation. And this establishes the power sale obligations between the project company and the utility, right? On the one hand, buyer and seller actually. There are several types of power purchase agreements. One is, as I mentioned, take or pay type contract is the best choice if bulk power is sold. So it comes into picture when you have a huge agreement or huge production of power, which is sold to public sector utility. This take or pay contract means that there is a contractual obligation to make period payments in future for an agreed offtake of power at a set price. And the purchaser must make specified payments even if it does not require the power at a particular time. So it doesn't actually it is not linked to the production, it is linked to the contract that either you are buying it or not, but you have to pay for that. Because sometimes there may be a fluctuation in supplies or demand. So in that case, in this kind of agreement, we have to buy it at a certain price for certain period of time. Okay. This agreement can be cancelled only by mutual consents. So you can't cancel the agreement unilaterally. Some other provisions of this PPA that defines each party's responsibility and penalties in case of non-performance under agreed terms are first, nature of the plant, second, base, load or peaking plant in the power sector, third one is tenure, fourth one is condition for the this power purchase agreement to come into effect. Then last is interconnection facilities. So these are few kinds of uh, you can say responsibilities which I have to carry out. So these I have discussed briefly about the power purchase agreements in power sector. Then now let's talk about the financing documents. So it basically financing documents govern the relationship between the project company and its lenders. So these documents are the rule book, a kind of rule book for the whole project's financing. And these documents create the legal mechanism to capture cash flows and protect the lenders. The primary major categories or basic categories of this financing document, number one is loan agreement. Then number two is security documents. And number three is intercreditor agreement. So we will discuss briefly about these after a break of 2 minutes. We will continue with this class. Let's take a pause of 2 minutes because continuous speaking is not so easy. So I will take break of for 2 minutes. Hello, students. Once again, I am back after taking this short break, 2 3 minutes. So let's continue with this topic of structuring the project. We are doing the structuring of a project. That is today's our topic, second chapter we are doing. And in this case, we are talking specifically at present about the uh, financing documents. Basically, primarily three categories of documents are there. One is loan agreement, second one is uh, security documents, and the third one is uh, intercreditor. So let's start with the first one. Basically, for documents that govern the financing of the project as agreement between the SPV and the project lenders, they are referred or means the financing documents. That is the meaning of financing documents. So first one is loan agreement, and This, depending on the bank and structure being used, may be called common loan agreements or facility agreement, then senior loan agreement, etc. It defines the amount and purpose of the loan and the terms of the loan, or what is the repayment schedule, right? Uh, so normally the repayment schedule of infrastructural loan is a balloon kind or step up repayment schedule with a defined moratorium period. Moratorium period based on the gestation period, expected time frame for stabilization of commercial production, debt service coverage ratio trend, etc. A similar repayment schedule is common in the case of non-infrastructural projects also. And seasonality is also built in this. For example, toll collection in a road project during monsoon months, non-crushing periods in a sugar project. To cite these are the two examples of having these repayment schedules in specific circumstances or seasonality incorporated in this. The loan agreements specify the interest rate, which because of the long tenure of the project are generally floating interest rate backdated to a benchmark, such as base rate of the lead bank or average base rate of the top uh, 4/5 lenders to the project or 75% lenders to the project. Right? There is no external benchmark such as gold securities, Government of India securities, has emerged in India for linking the rate of interest to long-term project loans. As far as the foreign currency loans or London interbank call money rate is used, we know that these are the uh, loan agreement at international level. Generally, the interest rate comes with a reset clause. This clause, actually, this kind of clause provides a hedge to the project lenders. I hope you understand hedging of the loans. Uh, it is also customary these days for the sponsors to include a clause for repayment or refinance at the time of date of commencement of commercial operations or interest rate reset. And these loan agreement define the uh, pre-commitment and pre-disbursement conditions, which we can discuss later. What are those preconditions or pre-disbursement norms? Then we have these loan documents clearly states the debt fees, service, representation and warranties and the condition that may be deemed as events of default and the dispute resolution procedures to be followed in case of default. Whenever there is default, these loan agreements clearly specifies the nitty-gritties of uh, what are the conditions laid down in these situations. Uh, Second type of agreement, which we have discussed, is intercreditor agreements. Uh, where these intercreditor agreements come into picture, uh, these are where the quantum of a project loan is very huge, very large, as in the case of infrastructural projects. In general and non-infrastructural projects such as steel and cement, the project loan is arranged by the process of debt syndication. Okay. Right. Uh, since we know that in syndication, the number of participating lenders is high and in an agreement is put in place among the different lenders, and that is very critical. And it facilitates coordinate actions and keep harmony of terms and conditions and for all these lenders. It also prevents action by any single lender. So basically that also gives a cushion to the single lender. This agreement preserves the right of each individual lender against the borrower by writing a procedure for the same in the agreement. And the agreement specifies lenders of facility agents, if appointed, and their rights and responsibilities are clearly spelled out in this. And we can discuss about this in next chapter. The project documents and financing documents along with the key contracts listed earlier, they are called transaction documents of a project as a one word, transaction documents. So as we have this, what is the strength of these transaction documents? They form the basis of project appraisal by the bankers. So for bankers, that gives a very sound base to evaluate the project or funding of the projects. If all the project parties are bound by ironclad these contracts at this stage and all risks are plugged in, then there is a little chance of a project not being successful. So it makes banks a very kind of soundproof system of returning their amount or funds by these projects. Okay, so this is crucial. In that way, it is very crucial. Then next is capturing cash flows. So while negotiating the terms of a loan, it is also pertinent to factor in a repayment profile such that it matches with the inflow profile. The repayment profile could be equal or front-ended or back-ended, ballooning, bullet, or equated. The borrowed funds can be unsecured loans and subordinate debt, which can be considered as quasi-equity. Subordinated, this debt represents finance with repayment priority over equity capital, but not over commercial bank loans or senior debt in the event of default or bankruptcy. Such a debt is usually provided for by the sponsors and has a schedule for repayment that is subordinate to um, the principal debt. And the timing of infusing these owned borrowed funds depends on the phase of development of the project. Then equity is also pumped in the early stages of development, while debt financing follows after financial closing. So basically, it is a critical to determine the extent of profitability of the project and its sufficiency in relation to the repayment obligations pertaining to debt assistance and servicing of sponsor interests. And the entire transaction of the project are routed through this trust and retention account, which is TRA. What is this? TRA is trust and retention account, where payments or disbursements are done during operations as per agreed pattern. So basically, this is the account through which payments are done during operations, as it is there in the agreed account term agreed we can say document. In a typical TRA with waterfall mechanism, we can see that wherein sub accounts and specific charges are created on the main account, and it implies that revenue of the project must meet operating expenses, administration cost, then debt repayment, then debt service reserve account, wherein 2 or 3 quarters of installments are kept as cushion against this default. These are the uh, issues which give me a minute. I'll So this one is the about the different kinds of documents through capturing cash flows. And next one is these are the points which we have already discussed. So this is the sequence. Typical sequence is uh, this is called sequential order of payments, where which ensures that project revenue is used for specific purposes before sponsors receive any money. What are the, for example, the typical sequence are these one. First one is operating cost and taxes, then debt service, which includes interest and principal. Third one is uh, debt service reserves account, which is in short called DSRA. The next is major maintenance reserve account. And the last one is distribution to sponsors, right? So let's talk about the security documents. Security documents, it's a kind of creating the security package for the project. And security documents are an important part of financing documents, and they protect the lenders in the event of default by the borrower. The documents define the claim of senior lenders over the subordinate ones. In times of crisis, it allows lenders to assume control over the project assets. The assets that are available for security are such as land, building, plant, and equipment of the SPV, or project assets besides receivable book debt and other contractual rights. So uniquely, the asset created out of project financing may not be available to the lenders, right? So it happens that these are not the accessible assets for lenders. The security documents generally involve in infrastructure projects. What are the some examples of security documents? The first one is toll receipts under TRA or escrow mechanism. Then second one is rights of substitution under which the lenders can replace the developers subject to the provision of the concession agreement. Then third one is uh, these senior security assets for enlisting the state assistance inadequate in acquiring land right of way such or so on. Then last is any other collateral available to the lenders. So let's, in case of these documents, mortgage document is another very important document, deed of hypothecation that is called. Uh, in response to this in response of some infrastructural projects, as most of the assets that are available to be offered as securities are project assets, and the project assets are under the concession agreements with government department. And there is a little by way of tangible security that is created in projects such as road, port, or airport development. uh, In the case of a power project, security in the form of mortgage of land and building and plant and machinery is available. In telecom projects, projects finance creates what kind of assets? Tangible assets. which is only the for part of the amount disbursed. Okay. Other assets that are available for security are examples are equipment, bank accounts, receivables of project assets, and pledge of sponsors, promoters, shareholdings. It may be partially or it may be fully. In the case of, as far as non-infrastructural projects are concerned, tangible security of project assets are land, buildings, and plant machinery, which will be available especially in manufacturing projects. While in the case of service projects, creation of tangible projects assets may not happen to the full extent because of their intangibility of services. And the full extent of the project loan dispersed in the case of these service sector projects. Collaterals such as pledge of sponsors, promoters, shareholding, and personal guarantees or corporate guarantees should be explored. And of course, the final call should be taken as per the delegated authority. So let's talk now about the mm, assignment of key contracts. So assignment of key projects, concession such as what are the key projects, key documents? First one is concession agreement. Second is licensing agreement. Third one is insurance contracts. Then offtake agreements, construction contracts, and so on. They are assigned to the bankers. And in the light of the lack of tangible security, the assignment assumes importance in certain types of infrastructure projects. Various guarantees are sought for managing risk or mitigating risks, such as example is completion of guarantee from sponsors or promoters. Second is termination payments from concessioning authority. And fourth one is force this major guarantees from insurance company. The next example, fifth is construction guarantee from project contracts. Okay. The deed of assignment of contracts will attract ad valorem stamp duty. Assignments are included as part of English mortgage. Stamping authorities have not levied additional stamp duties in these cases. So this is about the key contracts, assignment of key contracts we are talking about, which is called security package. So now let's move to the security structure, which is one is share pledge. In this case, lenders take a pledge over the shares of the project company, which we call SPV. What is its effect? If the project defaults, then lenders can take ownership of these SPV by enforcing the pledge, which we have already discussed, and this gives them control over the entire project, including all its assets and uh, contracts without a complex foreclosure process on individual assets. Right? So we can have this security structures discussion little bit here. Uh, as I discussed, mitigation of these payment risk by these off-takers is very critical for ensuring the viability of power projects. And in addition to direct payment security pledges in the form of such as letter of credit, that is called LC, and escrow agreements, these serves as a temporary measure of enhancement of credit worthiness of these off-takers. And then state governments or central government guarantees may also be explored Although currently most state government do not extend these guarantees because of this financial obligations. Although the security structure has been envisaged for payments dues, off-takers or SEBs in the normal course are expected to make direct payments within a stipulated period of time from the date of presentation of the invoice. The money in the escrow account is flow in and flow out, and the cash in the account will be trapped only in the event of default. Okay. Now the next another one is the direct payment. The project company would raise the invoices on a monthly basis, which means after generating and supplying the power to the state electricity boards for a period of 1 month. These state electricity boards or SEBs would have two options of making the payment according to the specification. Specifications such as number one, number of days from the presentation of the bills availing of the discount. Second, time say 30 days, for example, from the presentation of invoice to availing of a lower discount, say 1%. Example is giving example. Then next is letter of credit. These state electricity boards shall also maintain an irrevocable standby unconditional letter of credit issued by an acceptable credit-worthy bank in favor of the project company. These MLC will be opened in favor of the project company for an amount prescribed in these agreements that is equivalent to 1 month's billing from the date when the project company starts their selling power. And in the event of default in payment, the LC equivalent to 1 month's billing will be invoked in this scenario. What is escrow account? Escrow account is a part of the mechanism intended to capture the revenue of the purchase in case of default in making payments to the project company. Right? And escrow account is a designated account opened with a commercial bank. The main banker, these are the main bankers to the purchase of power, supported by a structure designed to ensure that receivable of the purchaser are deposited to the credit of the said account only. The banks have developed a model EA that is more suited to vertically integrated SEBs in pre-reform era. Okay, and we can have details of this, but that and in the case of default by both these Discom and Transcom companies, both these escrows are triggered so that the receivables are directly paid to the power producers by the consumers. The principles of these escrow would, however, remain the same under both the scenarios. And next one is the state government guarantees. What are these state government guarantees? They have been providing guarantee within a few to with a view to attracting investment into their respective states. This has been the practice, and over a period of time, the state government's guarantee was recognized by lenders and sponsors both as a part of the security package. So it works as a security for both lenders as well as sponsors. However, state governments have not now been extending their guarantees, and most of the power projects are being uh, funded without their guarantees. Why? Because of the keener interest shown by these promoters in setting up power projects. And also because the lenders now feel that securing the receivables of the power project is a better security option than the state government guarantee. So they prefer these kind of security. Next one is another kind of document is trust and retention account. The project company opens and maintain a TRA, that is trust and retention account, and deposit in this all the cash flows of the company into this account. And the proceeds, what is the use of these funds? They are utilized in the manner and according to the priority decided by the lenders. So these trust and retention accounts attempts to discipline the utilization of these cash flows entering a project company. TRA can be of two stages. One is called implementation stage, which is at the period of or during the period of its implementation, which is called what we call it the implementation stage, while the other one is operation stage. Okay, as far as the implementation stage is concerned, this TRA or this terms and trust and retention account in this stage structure requires that during the implementation stage, all project funds, either equity or debt, be placed into it, and the main account is designated as the proceeds account, which captures all the revenues. Okay. Based on the implementation schedule, or what is the schedule of implementing it, and during the implementation phase, funds from these accounts are transferred to the construction account, which is a sub account basically for meeting construction expenses, and to the interest service account for meeting the interest payment during construction expenses. Then withdrawals from these accounts are permitted on the basis of an approved major project implementation plan that is predetermined by project lenders on the basis of their project's status certification regarding these achievements of various yardsticks and milestones agreed upon at the outset or in the beginning. And such a mechanism is considered to be of paramount value to the project lenders for ensuring end use of funds and monitoring project implementation. Okay. It can serve as a useful tool for taking mid-course correction, especially in the case of long generational gestation infrastructural projects. So particularly, basically, it is meant for long gestation period projects. Second stage is operation stage. What we call it? Operations stage. Once the project is fully implemented and starts generating revenue from its operations, the entire revenue continues to be captured in the trust and retention account, while the construction and interest service account opened earlier are now no longer required, or we can say that they are closing down that one, and this operation stage account of retention, trust and retention accounts are maintained. So this is the this component of security document. So security documents, asset charges, as I said, a legal charge or mortgage over all the project company's assets, which includes physical assets, as I mentioned earlier, then intangible assets, such as contractual rights, permits, licenses, bank accounts, etc. The intellectual property rights are also in there, part of that. And next one is prevent it prevents the SPV from selling or pledging assets to others. Basically, this is a interconnected structure, and all documents and parties are interconnected. For example, the offtake agreement revenue feeds the cash flow waterfall, and the EPC contract delivers the asset that generates the revenue. Okay. While the security package gives lenders control over everything, whatever is the different aspects of that project, that security package gives control over their functioning as well as operations. So this is about the, as I mentioned, about the structure of structuring these project or the project. So we have briefly discussed these two topics today. And if you want, you can note down important question which may be asked from this particular chapter. I can dictate them or I can give it online. I hope you will get a flavor of the contents of this chapter, or what kind of questions you expect in the exam for this topic. Yes. So those who are interested to know the answer questions, some more specific questions are following. Note down these one, please. The first one is, what are the key project parties? What are the key project parties in a typical project finance deal? I repeat it. What are the key project parties in a typical project finance deal? Right? The second one is, what are financing documents? What are financing documents? Question mark. Describe these financing documents briefly. Describe these financing documents briefly. Describe these financing documents briefly. Third one is, third question. What is a shareholders agreement? What is a shareholders agreement, and why is it written? Why is it written? Next is, next is, how can you mitigate? How can you mitigate fuel supply, fuel supply and equipment risks. And equipment risks. So these are the probable topics which we have which we discussed right now, and we can check maybe these kind of questions may be asked from this topic. So basically, if we conclude this chapter, then we can say that uh, these project financiers try to enhance the structure with the security and uh, covenants as much as possible. But that does not prevent a litigation lawyer from finding many delaying tactics through the courts. Okay, and the bankruptcy and agency cost can be very high in a workout as much from the delay as from the many professional teams that may need to be mobilized, such as engineers, lawyers, and accountants. Uh, the margins and payments in proper financing, or in this case of project financing, are usually woefully insufficient to fund any serious workout or project. As far as the lenders are concerned, for the lenders, the deal represent a long-term commitment with many opportunities to go wrong and no easy way out except to book a these kind of loss and run. And the structure is built as robustly as possible, but when it comes to this litigation, court system, particularly in India, will inevitably tend to defend the borrower from the oppressive, so-called oppressive lender, with no one covering the interest bill during these interminable delays. So it's a kind of buoyancy towards the borrowers that he is talking about. So this is the kind of conclusion we can draw from this chapter which we discussed today. Different kind of financing documents were there in the topic which we discussed. So these are the main two chapters which we discussed, and now from in the next lecture we can start, or we can discuss the valuing the project and project cash flows, which will be the topic for our next lecture in next week. So basically, the two topics which we covered today, I repeat once again, are the first one was project finance and PPP markets, that is public-private partnerships. And in this, we discuss global finance markets, its status of projects, and then sources of funds for large projects, and then the examples of various infrastructural development companies in India and their role in this infrastructural finance. So I think this is the topic which we discussed. So it was for today. Now we will meet in the next class.